Common question I receive: can I save taxes by paying my kids? I'm George Judy, saving the world from tax, one bow tie at a time. The answer: yes, if done properly, but it's not so simple. So, I want to save money by paying my kids. How can I do that? Let me introduce to you what I'm going to call a bow tie trust. Others may call it a TOSI trust. TOSI standing for tax on split income. And I think we can all agree the bow tie trust sounds much better. Now, this isn't actually just for splitting income with minor children. This actually works as well, for example, with kids that are going through post-secondary education. This works well with a spouse that may not be involved with the business. This works well, in addition, to elderly parents. Several years ago, the government put in place some rules that really upset many business owners and investors called TOSI rules, tax on split income. And effectively, without getting into all the details, Revenue Canada has essentially taken the position that we have significant restrictions in terms of paying income and thus saving taxes when we involve people or pay people that are either too young or not directly involved in the business. There's an exception, and that's what the bow tie trust helps to get around. Let's talk some more details to see whether you and your family can take advantage of this planning. Income splitting is something probably more so accountants like to term the idea of spreading the family's income amongst the entire family. The purpose is that if, for example, a family made $200,000 and it's a family of four, if we're able to spread that income amongst four family members, their taxes will be significantly lower than the taxes as if we had to put that entire $200,000 on one person's tax return. The bow tie trust allows us to recapture, if you will, some of the glory days when we could do our income splitting. It's not perfect, but it's much better than most alternatives. Before we were using bow tie trusts, or rather trying to find ways of income splitting, we could certainly have, and there are alternatives. One, for example, is simply gifting money to a family member. But we have problems with that. From a tax perspective, there may be, depending on the family members involved and the nature of the income that is generated, attribution rules which apply. Attribution rules in English means that that income can, at least in part, be attributed back to the person that gifted the funds. In a similar fashion, we may do what's called a prescribed rate loan. And that allows a higher income individual to loan money to another family member or to a corporation or other entity. They have to charge, as you can tell from the name, a prescribed rate of interest, which is determined by Revenue Canada on a quarterly basis. Although it can be locked in, with the prescribed rate loan, we're still potentially subject, in certain situations, to that income attribution. The bow tie trust, however, helps get rid of or mitigate another screening problem with using a gift or a loan. That gift or a loan for many parents absolutely is fearful because they envision a Corvette sitting in the driveway the next day. The Bowtie Trust allows mom and dad to control the assets and the income, helping ensure mom and dad's wishes are met while tax savings are able to be realized. A huge benefit most parents are going to sign up for. Let's talk about the tax savings available with that Bowtie Trust. As an example, if someone was or has no other source of income for the year, and I'm referring to, let's say, a 5-year-old. Mom or dad, they're a healthcare practitioner, probably have a professional company, and they have a fair bit of income as they invest in both traditional and perhaps some non-traditional investments or alternative investments that many of our clients get involved with. If that income stayed at a corporate level, or alternatively, and often using an investment holding company, if that income were to go to a high income earner, the tax savings on, for example, an eligible $50,000 dividend would be approximately $20,000 per year. Ratchet that up a touch. If it's $100,000, the savings approximately $30,000 a year. And that savings is per individual per year. So those savings can certainly escalate over time. The Bowtie Trust, again, with a lot of rainbows and lollipops, it does have the same 3 disadvantages that a traditional family trust has. Namely, it costs a little bit more to set up. It's not the simplest of the things. In other words, it's a little bit of a pain in the rear end. It takes some time to do that. And the third disadvantage is that every 21 years, we have to re-kickstart that trust. I've described in the traditional family trust set of videos these points. Feel free to go over and check them out in more detail. Thanks for listening to our Bowtie Trust discussions. Please, again, subscribe. There will be updates as time progresses, and whether on this or other topics that will help you grow your legacy, grow your assets, and protect them. Please feel free to reach out, contact me using the details below. Let's have a conversation, see how the Bowtie Trust may fit into your family situation. Have more questions? Please subscribe, follow, and even share. I want all of us to have the tax information we need to do wonderful things.